Are you tired of your money just gathering dust in a low interest savings account with a regular bank? Well, let's beat them today. We're going to be going over the hacks that will have your money not just sitting there collecting dust, but rather to have options at your disposal that you can have your money while it's not being used give you more return. So it's actually working while you're laying in your bed at night. So stay tuned for the ideas and hacks that will have your hard-earned cash earning money while you sleep at night. Stay tuned. Welcome back to the Next Level Life Hacks, where we take the next step needed to grow towards our financial freedom and our success. Now, as I mentioned before, we're going to be looking at the importance of not just having your money sitting idly in a bank, growing at an expense to you, but rather simple options that will have you earning higher interests while your money is being saved for a useful purpose. Now, let's get some basics out of the way. Gone are the days where we could simply hold our cash in reserve under our mattress or have it somewhere sitting in a box, a shoebox somewhere in the closet. We need to find secure options that we can stash away our cash, not to perpetuity, however, but so that we can invest in the future, because you know that I'm a strong advocate for saving, but not for just saving for the sake of saving, but when an opportunity arises, you will have the ability to make use of this opportunity by having that cash to whether it be used as capital or just to invest in general. Now let's look at what happens when you bring your cash to the bank. Do you think it is sitting at the back in a vault somewhere? Yes, there might be a reserve that they need to pull from for their daily transactions. However, the majority of funds deposited to the bank is then turned into other investments on their end in major ways such as loans. Have you seen the major interest rates that are being charged on loans? Some loans can be as much as 20% while you're getting paid. The range of interest rate right now on your deposits that you're getting is roughly 0.01% up to probably 1%. 1% is probably the highest that I've heard of on a regular savings account, while your money is then taken and loaned to other persons for as much as 20%. How does that make sense for you? Then look at the fees that you are charged for you saving your money with the bank. Then, to add insult to injury, apart from offering you those minuscule interest rates, then the banks have the gall to be charging you those exorbitant fees: withdrawal, holding fees, processing fees, handling fees, and the list goes on in terms of the amount of things you have been charged for. So when you do that trade-off and that balancing off, the minuscule interest that you are earning on your account compared to the charges that you are facing, it amounts to you losing value or losing funds literally at the end of each year. No, that does not make sense. Look at it as well. Look at the inflation rate. Your money is depreciating in value while you're being charged and your money is eaten out by these fees that the banks are charging. Does not make sense. So therefore, while your money sits and waits for you to invest it, you need to make sure at least that you are not losing. At least you should be making what the inflation rate is, so that when you start pulling your money from the banks, at least you will have the same value as what you had put in previously. Now let's look at some simple, easy strategies, because I like to keep it simple so that I can be relatable to everyone. So the first one is to look at a high interest yielding savings account. And this is pretty simple. Many persons are not aware that they could be earning, as opposed to a maximum of 1%, up to 4% on your savings that is in these institutions. Now, if you want me to give you some examples of banking institutions that offer high yield interest savings accounts, then place it in the comment section so that I can do a video dedicated to giving you ideas as to which financial institutions these would be. Now, what I like about these higher interest accounts is that the process is relatively simple, maybe the same as opening a regular savings account, but you were just not aware, and that's okay. Ignorance is okay. However, what is wrong is that if you have the information as you are hearing now and still do nothing about it, then you are in the wrong and you are putting yourself, or you are doing a disservice to your own self, and you are actually sabotaging yourself. The good thing as well is that it is insured by the FDIC, so that your money is insured up to $250,000 per savings account. So therefore you have that protection, so you can have that peace of mind. The cons of it, however, is that the interest rates may still not be as high as you could be taking advantage of on the amounts that you have. And we are going to be diving deeper into other ways, because hey, this is just the first step. The intention of this step is to get you into action, have you start thinking and getting you actually motivated to start doing other things with your funds. It is not the first and only step, it is rather just a low-hanging fruit that you can start the process of becoming much more savvy in terms of what to do with your savings. Now, the next step in this direction that we're going to be looking at, because yes, we are looking at the higher interest yielding accounts rather than just the regular savings account. The next one we're looking at is the money market accounts. The money market account has a little bit more stipulation or restrictions than the regular high savings account. However, it is still better off than you having your money in the regular savings account. And sometimes these restrictions are good for you because, as I mentioned before, if it is that you are saving towards an intention and a purpose, then the funds that you are accumulating should not be easily accessible. There must be some restrictions to it so that it allows you to leave it be and it is actually a deterrent for you to be touching these funds. Now, of course, these money market accounts are meant for you to have easier access to, not full restriction at the other investment options that we will be looking at. So therefore, I would recommend that 3 to 6 month emergency fund that you are accumulating. And if you do not know what I'm referring to, then I'm going to have you go back to this video so that you can watch that, so that I gave you the importance and the steps that you should be taking to accumulate this emergency fund. Now, these accounts are perfect for that. Not funds that you would want to be using every day, but in case there's an emergency, it is easily accessible. Now, they do allow you to write a certain amount of checks. You cannot usually go into a bank for these accounts and simply withdraw the funds over the counter. They will give you a debit card and they will give you some check leaves and allow you a certain amount of transactions. So it is semi-restrictive in terms of the nature of these accounts. It is very critical with these money market accounts that the rates vary from institution to institution. So you need to do the due diligence as well to make sure that you are opening that type of account in an institution that offers you the highest interest rates. Shop around. It's just like if you're doing your car insurance or health insurance. Never you take the first option that is available to you, but do some shopping to make sure that you are getting the best offer that is available to you. Now we're going to be diving deeper and we're going to be taking a little bit more risk. But hey, we're going to be doing it responsibly, but we're going to be seeking to make more money on top of our savings. Because hey, we are here to maximize any effort that we are doing in terms of making money. We have worked hard for the money. We want to retire early. So therefore, we have to maximize our options. So the first thing that we're going to be looking at, and we're going to be starting slowly into the investment, we're looking at certificates of deposit, usually known as CDs. They offer a fixed interest rate for a fixed time period. Now, this will protect you because whatever the interest rate is that you agreed on and signed to at the beginning of this instrument is the amount that you're going to be getting for the duration of this investment tool. Now, it can be good and bad in that if the interest rate should go higher than what you started at, then you're going to be losing in terms of that gap. But if it should dip lower in terms of a turn in the economy for the worst, then you are protected that you are locked in at the interest rate, which would be a higher interest rate than the current rate at the depreciating market rate. All right, so it protects you. It is also fixed for a particular period, which means that you are not supposed to be touching these funds and should not have need for these funds during that period. So you're going to be at a disadvantage if you decide to break it because you're going to be charged penalties and fees, which would erode the interest rate that you would be accumulating. So make sure it is not funds that you're going to be needing for at least 1 to 2 years that you'll be putting into these CDs. This also protects you from running to these funds as well, because some persons, you will lock away something, then as soon as something comes up that you would deem to be an emergency, then you run to pull these funds and then put yourself at a disadvantage. So hey, they are locked away, forget about it, and you just look forward to that additional interest that you'll be getting on it. Remember as well that you might have kept these funds into a regular savings account and be earning less than 10% of what you're going to be earning off these CDs. So if you are not going to be using them anyway, at least choose the option that you're getting a higher interest rate. I strongly believe that anything that you are doing, you should maximize your probability and potential by seeking the option that has the highest possible returns. Next option that we're going to be looking at are the Treasury Bills. And yes, you're going to be getting higher interest than your regular savings account, and they are much more secure than other investment options because these are backed and offered by the government. So you have the stability of the government if your government is stable though, at an interest rate that is usually a little bit better than the market rate, and you have the peace of mind that these are backed and guaranteed by the government, so you can depend on the surety of getting these returns on your investment. Now that we have gone through those options, which are relatively safe in terms of you getting back your returns, we are going to be going now into the bigger boys. You need to be braver for these options, and you need to have an appetite for more risk. Therefore, we are looking at the investment accounts, and we're going to be looking at stocks, bonds, and mutual funds. Now, these are a little bit riskier, but they have much higher potential for higher interest rates and returns. But as I said before, you need to critically analyze them because they come with more risk. Also, they are usually for a longer period of time, so therefore you really need to know that you have these funds disposable and they are not going to be used for any time soon, so therefore you can play around with them in terms of speculating and investing in different options. Bear in mind though that for these category of investment accounts, I suggest that you get an advisor and some counseling in terms of which ones to invest in, so that you will not be making a mistake and you take it under advisement. Remember, I mentioned in previous videos that I have taken a different approach now to investing in business or financing in general, and that is to get an advisor or a coach. It is better to spend the extra in getting that advice from a coach than losing tenfold in terms of options or ventures that will fail. All right, so make the right decision. Now, some key takeaways and considerations for you to have in mind before you make any decision is one, your risk tolerance. If you are someone who does not like taking risks and you like to know that your money is safe and secure wherever you have left it, then you would consider the option of the higher interest yielding accounts, savings accounts, or the certificates of deposits or the Treasury Bills. Those will give you peace of mind. The next thing that you need to keep in mind is your time horizon. How long can you do without these funds? The shorter the period that you can do without these funds, I would go with the regular savings account in terms of the higher interest yielding ones and the money market accounts, or even a short-term certificate deposit of 6 months to 12 months. If it is that you can wait a little bit longer to access these funds, then we would look into longer period certificate of deposits and we would look into the Treasury Bills. Now also, in terms of your liquidity, you need to look at that. Do not be hasty and to be using up all of the funds that you have in terms of your extra savings and putting it in these short or long-term investment options, and then you're going to be left stranded or in a worse off or negative position should an emergency arise and you don't have a disposable income. Remember, anything can happen at any time. Medical emergencies, house expenditures in terms of house repairs or maintenance, vehicle maintenance and repairs, and just everyday miscellaneous things that might come along. So do not invest all of your extra cash. You have to bear your level of liquidity in mind. Another critical thing to keep in mind are, what are your financial goals? Do you have short, medium, or long-term goals? If you have long-term goals, then you need to choose the investment options that will lock away the funds for a longer period while they compound. Always remember as well that you should be choosing investment options that have compounding interest. Just listen out and ask for that word compound. And it simply means that your money keeps on accumulated interest on the previous amount plus the previous interest that have been earned. So you will realize that it is a multiplier effect, but it really works best the longer the amounts are being held in these investment options, that you will really start to see the multiplying of the funds that you're stashing away. My final advice is to you that if you can, you need to diversify your options. Have the higher interest yielding accounts for those amounts that you need to be pulling on regularly. At least it is earning extra than just the 0.01 to 1%. Of course, again, you diversify in money that you'll be needing in the medium term, put it in certificate deposits, and then diversify for those long-term funds that you'll be needing, for example, for retirement, that you will lock away into those longer term investment options. So as usual, my friends, if you have found any part of this content to be beneficial to you, please like, comment, subscribe. As a matter of fact, place in the comment section below if you have any other suggestions as to options rather than keeping your money locked away in those low interest savings accounts. All right, thank you for watching and see you in the next video.